This is Fred Harrison, and Fred has correctly predicted the last two property crashes, both the 2008 and 1990 property crashes. And the craziest thing about those predictions is it's not like he predicted them a few months before they happened. He predicted they would happen years in advance. And now, Fred is predicting house prices will crash in 2026. In this video, we're going to discuss and explore Fred's theory so you can decide if you think he's called it right or not, and also talk about how you can protect yourself as a homeowner, buyer, or property investor, and most importantly, thrive by understanding the opportunities hidden in Fred's forecasts. Before we look into this, please like and subscribe because it helps me out. Anyway, who is Fred? Fred is a research director of the London-based Land Research Trust. He studied economics at Oxford, and in 1997 he published a 10-year forecast specifically highlighting that a global financial crisis would be triggered when house prices peaked in 2007, which just blows my mind. So I think it's fair to say Fred's a smart guy and someone we should all be open to the opinion of. So let's break down Fred's theory. Well, he was one of the first people to identify the existence of the property cycle, which is the foundation of his forecasts. He researched the UK property market over hundreds of years and concluded that the length of each full cycle averages out to about 18 years, with each cycle divided into distinct stages that we'll go through in the next section in a moment. But before we do, it's important to recognise that you, me, we all need to make our own decisions about how we interpret information, and that includes this whole 18-year property cycle thing, because in general what history teaches us is the professionals who are watching the factual signals act very differently from the amateurs who are watching the media clickbait titles. The news does not always match up to the reality of what's happening or what's to come. Back in 2006, you can find articles about how to get the best rates on 110% mortgages, which in retrospect just seems mad. And so many amateurs would have looked at those articles, got those mortgages, and ended up in a lot of trouble come the crash. I get the sense the fact that you're watching this means you are more the professional than the amateur, the wolf rather than the sheep. If so, why haven't you liked this video yet? But let's look at the 18-year property cycle in more detail. First, we're going to talk about what these phases are and then overlay it to house price data up until now for you to see if you think it matches up or not. So to start, when you've got this recovery phase, this is the stage after a recession where house prices have bottomed out at the end of the recession and prices have fallen far enough to start tempting the bravest investors and buyers back into the market. Usually, investors are attracted back by the higher rental yields on offer as a result of prices falling while rents have stayed pretty much the same. Although house prices have fallen in the past, rents historically don't. So if you're renting thinking, great, I'll buy at this stage, even those brave enough to take advantage of the lower prices and buy tend to find it more difficult at this stage to get mortgages, usually because banks tighten their lending criteria due to the perceived increased risk to lending. You've got to remember, on the back of house prices dropping, it's not just homeowners that struggle, banks do too. So they're naturally really cautious, especially during the beginnings of the recovery phase. At that stage, no one really knows if prices have hit rock bottom yet. And the media is usually really negative, unsurprisingly, constantly highlighting the negatives of prices dropping. Because of this, it's usually at this stage you have a complete absence of amateur investors or buyers. But in reality, the best time to buy is at this stage, which is why you get the more experienced contrarian investors, the smart money, in other words, that start their process to buying up more and more property. They take advantage of the absence of competition and prices being so low. As the recovery phase develops, you then get more and more buyers entering the market as more and more begin to realise the upward trajectory of prices, and more optimism begins to return to the market. However, there has historically always been a slight mid-cycle dip as prices stabilise or even drop slightly. This might be because early investors finish investing or decide to sell and cash in profits. Often this mid-cycle dip gets confused with the end of a recovery and the beginning of a recessionary period in the property market. Typically, this period lasts 1 to 2 years on average before prices start to rise again. You then hit the explosive phase. This is where confidence in the market increases dramatically. At this point, banks are usually over the shock of the recession and begin relaxing their lending criteria and are willing to start lending more and more money. That starts supplying more and more money into the property market, and it then becomes a self-fulfilling prophecy. The more money that's injected into the property market, the higher prices rise. At this stage, all the news headlines talk about house prices are increasing quicker than wage growth, and people start rushing to get on the housing ladder or move up the ladder as the fear of being outpriced in the future starts to set in. This then pushes prices up even further and further because there is so much optimism. Banks keep lending. You get the odd commentator like me and others warning of the unsustainability of all this. But of course, people ignore it, comforted by the fact that house prices always go up, don't they? Which, although true over a decade, isn't always true year to year. Final couple of years of the explosive phase is what Fred Harrison brands as the winner's curse phase. Why is it a curse to be a winner? Because you've essentially bought a property at the highest point before house prices start to drop. You've essentially bought at the worst point possible. If we overlay this 18-year property cycle to actual property data up until now, it is quite alarming. You can see clear as day how house prices have worked their way through the recovery phases after the 2007-2008 financial crash. You can see house prices keep rising despite the Brexit referendum and all the things attached. Remember, at this point, everyone was forecasting house prices to drop, and of course they didn't. House prices seem to have a mind of their own at this stage, with the mid-cycle dip the year heading towards COVID. And since 2020, house prices have exploded until you reach the close of 2022. If we look at the price data beyond 2022, it is at this stage we start to see house prices begin to flatline a bit. And this can be more clearly seen if we look at not average house prices, but the percentage change in house prices for the same time periods. Now, I'm not in the habit of fear-mongering, but it does look like house prices are starting to drop. And this is my personal prediction of what I think is going to happen. Either we're going to look back at this and I'm going to have read this all correct, all right, or I'm going to be wrong. But my opinion is, in reality, it looks like we're heading to house prices being uncertain this year and next, as everyone holds onto this hope of interest rates dropping. You can see the left red circle looks awfully similar to the red circle, and you can see what follows the left red circle, the crash. It may be the case interest rates drop slightly end of this year or next, but I think in reality, as people realise higher interest rates are here to stay, we're going to start to see a shallow correction in house prices end of next year, exactly when Fred expected, amazingly. I don't think it's going to be as drastic as the last crash. I think at most prices might slide 5% and then begin to slide up again. It will be a slow dropping of house prices and a slow rising of them on the back end. Look, I could be wrong with this. This is just how I choose to interpret the data rather than just follow the headlines. In my last video a couple of weeks ago, I go into detail over default rates on mortgages and current repossession rates. And it is quite clear default rates have significantly increased over 2023, but because of the lag between falling behind on payments and being repossessed is about 12 to 18 months, we've not quite felt the effects of it yet on repossession rates. As you can see, repossession rates, although not increasing significantly, are increasing. And if you look back at the default rates dramatically increasing, what do you think is going to start happening here to repossession rates? I think they're going to keep going up, and dramatically. Anyway, the point of this video isn't to fearmonger, it's also to help you navigate and work the situation to your advantage. So how can you protect yourself? I have 3 core tips I follow. 1, you need to always run your life on the expectation of high interest rates. I model everything around 6% interest rates. I have done for years. You want to know if interest rates stay high or get higher, you can still afford to live in your home and your property investments are still profitable. 2, I always aim to buy below market value or buy to add value. The bottom line is, if you're buying something 5 to 10% below value, or you're adding 5 to 10% of value by refurbing the property, you could buy at the height of the market and not live to regret it. If you don't know how to buy low, my business personally sources between 100 to 200 properties for investors every month. Check out the description below to see more. And finally, 3, don't panic sell. If you follow points 1 and 2, you should never have to sell at the worst time. But just because you don't have to sell doesn't mean you won't, out of panic, sell. Stay calm and focus on long-term price trends. If we go back to the 18-year property cycle, notice how the end of the recession phase on the right is still higher than the recovery phase on the far left. The point here is, house prices dropping does not mean house prices drop over the longer term. They go up. The danger is you don't want to be caught out by buying high, then having to sell low. So see you up here in the next video.